I'm 680 News senior business editor Mike Eppel. We saw a quick reversal of fortune in the energy market today after that near record-breaking 15% spike in the price for oil Monday as the market reacted to those drone strikes on the Saudi Arabian oil production infrastructure. Well, the report today, according to sources within Saudi Arabia, that those production facilities could be back up and running at least 70% output in the next 2 to 3 weeks rather than a matter of months. So there was a reassessment on the state of the oil industry globally today, indicating that the demand is fairly weak right now. There is a lot of oil in the pipeline system, including record-breaking daily output out of the U.S. Talk that the Alberta government could raise some of the production quotas that had been put in place earlier this year, only if that rail, however, or oil is delivered by rail, however. But the added supply stabilizing things somewhat, and the price for oil quickly dropped back by more than 7% during today's trading session. Price at the pumps, meantime, going up at midnight tonight. Enpro International, Roger McKnight, the chief market watcher there, saying that the price will rise by 4 cents per liter to just below $1.21, peak price here in the GTA. Well, it looks like General Motors could be digging in for a fairly lengthy work stoppage at its U.S. operations after the United Auto Workers Union walked off the job early Monday morning, shutting down over 50 plants, General Motors production facilities and parts plants nationwide. More than almost 50,000 people off the job. Reports today indicating that General Motors actually has a lot of inventory on the dealership lots, upwards of 99 days worth of inventory for the highly profitable pickup trucks and 77 days of inventory for all types of vehicles. So that gives them some room to maneuver when it comes to those contract negotiations, and they don't necessarily have to get production immediately back up and running. Latest indication from Canada's economy today, pointing to a little bit of a summertime slowdown for the manufacturing sector in this country, led by some furloughs of the auto sector during the summertime months. July manufacturing sales, output, production, all down by more than 1%, according to some data points in from Stats Canada, and that points to a fairly sluggish start to the second half of the year for the economy. The economy front and center tomorrow, when we'll get a decision on interest rates by the U.S. Federal Reserve. The Fed is expected to cut rates for a second meeting in a row by 0.25%. Today, even with that falling price for oil and retreat for energy stocks, we did see another record high for the Toronto Stock Exchange today, fourth day in a row. The Bay Street benchmark set some records. From the 680 newsroom, I'm Mike Eppel for City News.